Hi everybody, welcome to our Let's Learn Futures webinar series brought to you by Bursa Malaysia Derivative and managed by LifeChamp. My name is Shane. I will be the moderator for today's sessions. Now, the session today is all about spread trading, the best kept secret of futures trading. Now, have you heard of spread trading? Now, not many people actually heard about spread trading. If you do, you must be, quite well read and quite knowledgeable about this futures industry. So today, our speaker is going to unveil to you what actually is spread trading, which is another trading strategy aside from outright trading that most people do. That is not many people know. So today, he is going to review to you how he used spread trading to do to trade futures for a living. All right. So before we proceed, as usual, disclaimer, whatever we share on this webinar is only for educational purpose. In no way that this webinar give you any buy call or sell call or long or short any positions. So if you decide to make any financial decisions, you do it at your own risk. Okay. All right. We have James who said that he has heard about spread trading before. Excellent. Now, this we still have 11 more session of derivative webinars that are arranged for you. So next one is on next Thursday. So please reserve your calendar for next week futures webinar. Now, today, let me introduce to you this speaker. He actually came to share about a session with us like last month on how to become a full-time futures trader, and today he's going to share with you his secret, his strategy on how he used spread trading to make a living in the futures market. He is a full-time trader. He is a founder of Strix Index and Berhad, a proprietary trading company and associate participant of BMD. So in other words, he's a prop trading firm boss lah, and he's a former local participant of Bursa Malaysia Derivatives. So it is not very often that we can hear from the boss of a prop trading firm. And he's also a full-time trader. Every day he trade in, trade out in the market. So he relied on futures trading for a living. So to become a local participant of Bursa Malaysia Derivative, you need to trade at least 1,000 contracts a month. And to be an associate participant of BMD, you need to trade at least 10,000 contracts a month. So to him, 10,000 contracts a month, right, is it's like drinking water. Okay, it's a no-brainer, so easy job for him. Right. So without further ado, let me hand over the session to you, CC Young. Are you ready?
Yes. Hi.
All right. Cool. I'm making you a presenter right now.
Okay.
So we are ready to learn from you.
Thanks for the introduction and good evening to everybody. So yeah, so this is what I do, and as Shane said, so I trade futures for a living. So today I'm going to share with you a trading strategy which we call spread trading. Of course, I didn't invent this spread trading, but it has been best kept for a while. So we are actually, uh, not many people has been maybe talking about it, but it has been there for quite some time. So let's start this presentation on spread trading. Okay, right. The spread trading is also called relative value trading. So spread trading are actually the act of you purchasing one security and selling another related security as a unit, okay, as one thing, okay. So usually a spread traders are done with options or futures contracts because you need to buy and sell something uh, only to achieve a spread. All right. So that is why futures and option is actually much better instrument to do this. So these trades are executed to produce an overall net trade with a positive value called the spread. So that means the difference of these two prices or these two thing, then you can actually call it a spread. All right. So spread are priced as a unit, which you call it a price. Okay, that means let's say if you call a spread of 2 ringgit, means the seller and the buyer, the difference of it is actually 2 ringgit. So it's called a spread also. So when you go to money changer, so the buy unit and sell unit price are also we call spread. So usually some actually traders rely on spread to make the money. So spread are priced as a unit, okay, or as a pair in the futures exchange to ensure that simultaneous buying and selling of a security. In these terms, it can be a securities, can be something else, it can be futures, can be any instrument. Doing so eliminates the execution risk where one part of the pair execution, but another part fails. That means you buy in a pair. So that is called spread trading. Of course, some spread trading can be done in different we call leg in and leg out. But in this case, you will buy in one pair. We'll show the example in just a bit. Okay, types of spread trading. There will be many types of spread trading. There's some exotic, spread trading as well. But we're going to show you the common one that we use first. The intermarket spread, which the spread of two different instruments, namely, let's say for example, FKLI and also the FM70, which going to be relaunched soon. So I'm sure this webinar series will have some more information on the FM70 spread. Okay, so intra-market spread or calendar spread. This is what we're going to focus on because Malaysia has got one very unique calendar spread available from our exchange, BMD. So this is what most of the spread trader in Malaysia are focused on, and there are actually more exotic inter exchanges spread like crude palm oil CPO in BMD Malaysia. You can actually versus the soybean oil in seaboard US. So you can trade this kind of spread. You can also trade the gold futures in COMEX and also gold futures in BMD, which is FGLD. So although the contract size is different, you can get the calculation actually quite easily lah. So you can check out on the spread itself. In fact, nowadays trading tools are widely easily available. Even many are free. For example, TradingView, you can actually call up BMD CPO minus, let's say for example, soybean oil minus crude palm oil. So you can get a spread of these two instruments instantly. Of course, the free version has got some limitation, but they are actually the historical price at least is correct. So you can do such a spread analysis, from two free available over the internet. Now, spread trading as a trading technique. This is what I mean. When we trade spread, we think of not only spread as one unit, but we also trade spread as a hedging and outright position. Meaning to say, if you have outright position that in trouble, let's say you long the market actually went down, you can short the adjacent contract to form a spread to hedge your position. That means your position will be locked in certain difference or certain price. At least during the turbulence of market, your price will be not too far deviated from the spread. Now, hedging a spread position is another technique. Okay, means you have one spread, but this spread actually the price you think the market is actually not going to favor you in short terms, but in long run it could. Then you can actually do the opposite spread to hedge your position. Now, most of the time, you will see that a spread trader try to find a way, okay, to neutralize the market open position. That means we don't have, or we don't want to have any open direction in our position. We want to be as market neutral as possible. Market neutral in here, we mean that we don't favor the market go up, or we don't favor the market go down. The market can either go up and down, but as long as our spread is actually can benefiting from it, then we are okay with it. So this is how spread traders mindset or the technique that we're using. Thirdly is rollover. You might have learned about rollover for some time. Let's say you have a position that you need to, from 1 month before it's expired or 2 months before expired, you need to transfer into a back month. Then you need to do rollover. How to do a rollover? Usually spread trading or spread is the best instrument for you to get the rollover. Let's say you roll from, let's say FKI, for example, September to October. If your roll price, the spread is zero, you buy or you sell the spread at zero, meaning to say you roll from September to October at zero. That means the price no change, only the contract change. But if you roll over from, let's say, for example, September to October at the price of 5, okay, if you're holding a long position, FKI, let's say we call it you're holding a long position, then if you're rolling at 5, means your advantage of 5, because you roll at 5, you sell the spread at 5, but eventually market converge back to 0 and 0, let's say, for example, then you're making 5 points during rollover. Or sometimes why this happens? This happens because the rollover also, we treat this as a compensation in FKI. Let's say, for example, which you don't get the benefit. Let's say you're trading FKI, means you're trading the top 30 stocks, but you don't enjoy the benefits of let's say, for example, dividend yield. But the rollover actually give you back the 5 ticks as a dividend yield. If you treat this way, this is how we treat the market. This is how spread trader think, right? So that's why we price it such a way that this is a we call a fair value to roll. Such that's how we price the spread. Okay. So on rollover, lastly but not least is we counter trend trading. That means you see, when the market going up, what is the easier execution that you can do? Sell. It's not buy, because you will feel like very difficult to buy, because you try to get one tick better, but you will never fail. But if the market going up, you do a counter trend trading, so it's easier way to get filled. But problem is, you do a counter trend, it's so easy to lose money. So spread traders or spread trading actually provide such trading mechanism which you can actually do a counter trend trading. Okay, over in our popular spread in BMD, we will have the FKI, FGLD, of course, FM70, as I said, is going to be revamped and better contracts. So looking forward on this, but today we're going to be focused on candle spread alone. So in candle spread, usually we trade FCPO, which is the futures of crude palm oil, CPO, and also the FKI, which is a KL CI composite futures. So these are the most popular contracts. In fact, if you talk about candle spread contracts, I believe our CPO is one of the most active candle spread contract trader in the world. It's not a joke. Actually, it's really so active. Consider the contract that we are trading, so many contracts and so active. People are actually focused on trading, actively trading almost like all the contracts, like 2-3 years contracts, this is one of a kind. If you go to any exchanges abroad, you may not find such an active candle spread contract trading in the market. So what is candle spread? Candle spread is you buy and sell contracts expired in different month, but in the same exchange. For this, in this case, okay, futures contract must have an expiration date. So that is makes the futures trading become very exciting. So they have different expiration date. So that also makes or created a form of spread called calendar spread, because different month has got different prices. So this is an arbitrage method for bull and bear market. Meaning to say, if you look at the market as bull, then you do a bull spread. If you think the market going to be bearish, so you do a bear spread. That simple, actually. Of course, it's not as only simple like this, but basically this is the idea that you have to keep in your mind what is going on. Okay. Now, spread trading provides liquidity for traders and hedgers, and spread traders also spread the risk across different candles month. Because there's existence of spread traders in our market, so that's why you see why our contract are not only focused on, let's say, the active month, but the next month of the active month, the 4th, the 5th, the 6th, 7th, 8th, 9th, 10th, 11th, 12th, all the 12 months plus, the additional another 2 years, all the contracts are seamlessly very, very active. Okay, compared to other exchanges, maybe 1 year they have 3 contracts, but only one is very active, the rest are very, very inactive. But in Malaysia, the calendar spread are almost, the 12 months contract are very, very active. Okay, so this is because we have the calendar spread. We have used to spread the risk, and there are a lot of spread traders actively trading. So you can almost like can buy the 3rd month, the 4th month, 5th month at any price that you feel like buying. So example of candle spread is you buy a November contract and you sell a December contract. You see, spread must be a buy and sell or sell and buy. You cannot buy, then it's not a spread. Okay, if you buy a contract of November and you sell a December contract, our exchange has got a very advanced system where automatically it's considered count as a spread. Okay, so your margin, all the relevant mechanism will be recognized your position as a spread. So this is actually very, very good because we have all the built-in system here. You don't have to do your manual spread like many other exchanges or instruments. Now, we will focus on this calendar spread on FCPO. The reason is because they have 36 months down the road that you can trade. So there's more contracts to be traded. But why FKI has got lesser contracts? It's not because of it's not designed such way. Because financial indices all are traded as cash and they are not physical delivery. They are cash settle. So most of the contract are traded this way. So you can go to any countries, the spread or the way they keep the contracts are in such a way. All right. So we'll focus on palm oil. And why CPO? Because it is a most consumed edible oil. So if you trade something that most people are consuming in the world, so you are actually not very far from trading something that very, very actively, and they are actually traded in uh, in Malaysia, okay, which is our country, and then they are traded by all the traders over the world because everybody have to buy the oil from us or Indonesia, these 2 countries. So they need to hedge the prices, or they need to get the stock at certain prices, or they need to discover the price. So they have to look into our market. Okay, since this is most edible, you can see the blue histogram is actually the highest, which is the most consumed oil. Second is actually soybean oil, and the rest lah. So since it's most consumed, you can rest assured that traders from across the world are trading it. So over time, you will hear that people may actually rumored, someone corner the price, someone control the price, someone do this, did that, to certain prices of commodities, which is very, very difficult if you want to apply in market like us. The reason is because everybody is trading this instrument, and we are the largest one. Second, then we have soybean as well, edible oil, but their trading market actually volume could be bigger. You see, if you try to corner the price, control the price of palm oil, eventually create an arbitrage opportunity for soybean oil trader. So you will see that it's so difficult for you to push a price to crazy high. Let's say to push from 2,000 to 3,000 to 4,000, just to make money from others, which is impossible because there are spread traders, there are arbitragers, which these people will actually benefit from if you're trying to control the market. So that is very important element, which if you pick something as your full-time trading instrument, so this is one of the reason you can actually consider, and you should consider actually as well. Now, second is our palm oil is benchmark edible oil during Asia time. You can trade soybean, but soybean oil are traded actively at night, until 2 something a.m. So it's difficult for us in Asia to trade something that not in our active time. But palm oil is trading in our active time, but the market influence in the oil world or oil market is we are the benchmark during Asian time. That means everybody look at our instrument. So trading it as good as you're trading other instrument in terms of edible oil lah. So thirdly is correlationship to soybean and crude oil. So this has got some correlationship. So if you're in this industry or you are actually in interest of studying this kind of instrument, so you are actually trading FCPO become one of your benefit of uh, trading something or related to all these instruments. Now, fourth is all year round production enable unique spread trading strategy. This is why calendar spread can be so successful in Malaysia because our production of palm oil is from January to December. But of course, there are high peak season of production and there are low season for production, and there are high export season and there are also low export seasons. So that makes the spread become exciting because we have every month production on the palm oil, whereas other crops they may have, let's say, harvest seasons, so which are more active. So the difference is some of the months they are very active, some of the months they are not. So that makes the calendar spread become very difficult because you don't have all year round of production cycle. So which means the production cycle become very important elements in trading this instrument. All right. So to show you this example, you can see that there are many contracts here from May, June, July, August, September, blah 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 until the next May. So you have one full calendar plus one actually here of calendar, okay, that you can trade. All right. So that is actually very unique because all the quoted price there are actually the price of people willing to buy and sell. Okay, we call price discovery. So you can see that the first one is May at that time, 2019. It's 1919. The price is actually below 2000. That time was you consider very cheap. Okay, but do you know that after a few months, the price, let's say as of now, it went to 3000, almost 100, just a day, a few days ago. Now, you look at this trend. Look at this trend. May 2019 is 1919, which is below 2000, and May 2020 is 2300. This is exactly where the price when it was traded few months ago at 2300 odd. Okay, so what this means, you see, the price itself actually give you the projection of the price, potential price or of different month of delivery. That means now you're 2019, the price is 2000, but look at the price of 2020 May, it's already 2354 ringgit. So that means the 5 months price higher. So this actually can create an opportunity. Let's say, for example, if you buy the oil at May 2019, if you sell to May 2020, you actually make almost 400 ringgit. Of course, you cannot do that because you buy May, you cannot store the oil until May in the future, right? In 1 year later, you can't do that because the oil is a perishable oil, and you have to take the delivery. You have to store the oil. Storage has got cost for you as well. So then, how you want to make this strategy works? Because you know that the palm oil cannot be so cheap below 2000, so it would go up. Of course, you can buy the one contract and keep forever lah. You can do that, but you can't buy futures contract and keep forever because it has got expiration date. So in this case, you try to buy May at, let's say, 2000 lah. You try to sell May next year at 2300. You want to make 300 bucks. How to do it? What you can do is you buy the futures contract. But in this case, you cannot buy the May because you buy the May at 2300. Let's say, for example, the next year, May. Okay. What you get is when the time comes next year, the price is exactly, let's say, for example, 2300. Okay. So what you gain? Nothing. You lose, not necessarily, but you lose quite a lot of time. Of course, you may gain, but in this case, we give you an example. You may not make money in this case. So what you can do is, if you slowly roll your contract to the next month, then you can collect all the spread profit. Eventually, you will collect that 300 ringgit. So spread trading can be, so exciting. You can create so many things out of, can I say out of nothing? Because you can look at the prices different, but the difference is the margin that you can make from the market. Actually, the market already display you we call a curve, a price curve, showing you how the price can be projected or can be predicted in the future. But how to prosper from it is something that you need to think of, and this technique is actually spread trading, right? Okay. Now, of course, trading has got something to think about. Your concerns could be this is a physical delivery products. That means if you buy oil, you have to take delivery if you go to spot month. So you cannot trade the spot month if you're not willing to take the risk of actually delivery. Yeah. Okay. Second is a perishable soft commodity, so you cannot buy and keep forever. It's not like gold, you buy, you keep forever. So you need to either roll the contract or you cannot buy the physical contract. So you have some limitation, but as long as most are trading third month contracts and forward, then you don't have this problem. In fact, nowadays, because recently BMD has got actually improved the contracts. Last time you have only 6 month consecutive contract, meaning 1, 2, 3, 4, 5, 6. Now you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months continuous contract. So that means you can take a position in up to 1 year in any calendar month that you wanted. You can actually take a position. So that's why the risk of perishable soft commodity or expiration will be slightly lower compared to many contracts. Okay, and then spread trading actually extended after 12 months to even 36 months. But after the 12 months, only the odd months will be included. The even month actually will not trading until the 12th month in the 12th calendar month. So this one you have to keep in mind. All right, let's speed up a bit. Okay, trading CPU or futures or spread is actually trading so-called fundamental. Here you can see that this is a heat map. Heat map showing you every January the price will go down. February price go up, over the past 10 years. Okay, and March go down. If you look at this is a cycle. It's a trading cycle. In fact, it's more easily you can say this is a production cycle. So the price is high because production is low. Okay, the price is low because the production is high. So this is an idea how you create trading idea from spread. Okay, this is what you can look at. It's easily the data I think easily available. You can even snapshot this. You can actually do your own chart every month. Now, trading plan. How to plan your trading is you can trade, instrument spread, blah blah blah. Okay, but these are the things that you have to be really sure, especially like position sizing, risk management. We have this just in a bit. All right. Now, let's be focus on spread trading. Now, I assume I have just explained. Let's say you can long January and then you sell February. So this form a spread. So we call a Jan Feb spread, so it's easier for us to understand, which is meaning if you buy Jan Feb means you buy January, you sell February. If you sell Jan Feb spread means you sell January, you buy February. But some other countries, some other instrument, they have reverse spread, so the meaning is different. Okay, just that. But we want to go focus on this now, right? Trading a spread, actually good thing is actually allow you to dodge a turbulent market, and you can trade with pure spread strategy, which is what we're going to do. Okay, I'll show you how it works. Different months has got different contract price. So I brought these prices into chart. Now, these charts shows you how the price curve. Just now we showed an example, the near months are lower, the further months are higher, right? So in this case, let's say for example, I buy the near month contract because it's 2,116 low. Let's say for example, okay, this is just example. Don't do this, okay? This already past data, okay? So I'm going to show it to you how you execute a spread. But of course, you don't do it only this way. There are much simpler way. Now you sell a 5-month contract because you want to buy. You basically you buy low and sell high, but across different months. Okay, so you buy the near and sell the far, for example. So the next day the price shift. Okay, the near month goes 36 points higher, but the far months only go up 10 points. So the one that you long, you make 36 points. The one that you short, you lose 10 points, right? Okay. So what is your net profit? Your net profit is the plus minus the take out the losing lah. So your net is 26 ticks. So you are making 26 points by long and near and sell far. This is how spread works. Okay. In actual form, right? But of course, we are talking about technology. We trade something much simpler. Later, I will show it to you. So basically, you don't have to really worry about buying individual month of November and selling individual month of March. What you can do is in this contract, you can buy a November March, which equivalent to this trade itself. So if you buy, let's say for example, you executed this, you buy November March. The next day, the November March will go up 26 ticks. Let's say from 10 to 36, then you make 36 point. But trading a far or long spread actually carry bigger risk. You can trade a smaller one. Let's say you trade January, February, March, April, May. You can try this. Now, trading is all about risk management. If you control the risk, then you're actually trading. If you go in and out in buy sell contracts, but without controlling the risk, you may be considered you're actually trying to bang on your luck. Okay, so risk management is critical here, because check out these statements. Whenever you sign a form, open accounts, or disclaimers, you will see this. It says past performance is not necessarily indicative of futures trading results. So that means whatever you see the result, it may not work, right? Second is futures trading represent speculative investments and involve high degree of risk. What it means? It means futures trading is risky. Actually, the worst is actually the last one. Of course, I'm not going to try to skate it, but in fact, I try to get you to understand. Then once you understand, then you know how to contend and control it. So an investor could lose all the or substantial portion of his or her investment in trading futures. This sounds so scary. So is that so? Not necessary, because after I'm trading futures for some times, I realized that the futures, because it has got allow you the short and longs, and especially in spread trading, so it has got less risky compared to other instrument in my opinion. So what the trading and risk is, trading involves risk. You can't run away from risk, but you can control it. Trading is to risk your equity on a trade. Okay, futures trading has risk just like any other trading instrument. This is important. If you think trading futures is actually more risky than another one, is actually you're getting the whole point. Maybe not like what we're thinking lah. And knowing and understanding the risk is key to successful trading. If you really want to make trading for a living, so probably this is what you could really improve by knowing this. Let's say I give you an idea. FKLI theoretically should never go to zero, because all the top 30 companies should never bankrupt, right? Because they are top in terms of capitalization. Now, assuming FKI stood at 1,008 now, okay, the value of 1,008 per contract is 50 ringgit per points, then it's worth 90 ringgit. Now, if you use 90,000 ringgit or even half 45,000 ringgit to control one FKI contract, which you could use 4,000 now, which is 20 times lower. If you use 9,000, you need to lose 1,800 points, or half is to drop half, yes, in crisis. But does it wipe out all your account? Not necessarily. This means actually the risk carries is actually not as risky if you have adequate margin to withstand any whipsaw in the market. So that means don't overtrade. So if you use high margin leverage, or the real leverage is actually the risk to trade stocks or even securities, the investment can be as risky as futures. That means you use cash to trade stocks. You may say no risk, but if you use cash to trade futures, then futures no risk. But what the futures benefits giving you is that futures can be shorted. Second, you can have a default margin account from a start. Okay, trading stocks, you may not have default margin account, but futures, you have the account default in a margin format already. So this is try to use that risk factor to become your advantage. But a lot of people will use the leverage as a where to make money. Okay, but leverage or is actually where the risk comes from, So now, how to contain the risk? Understand these 4 points. Okay, so basically what I'm trying to say is that the trading technique is actually not critical. The risk management is actually. So first you have risk per trade, you have risk rewards ratio, winning ratio, and number of trades. Okay, what are these? Risk per trade, how much you risk every time you go in. So you will read a lot of articles. People will say that invest all this money into certain equities, certain instruments, or certain trades. But in reality, we try to be minimum investment per trade as possible. You'll be surprised every lot or every time that I'm going in terms of lot size. It's very small, relative small in terms of the account that we are trading, because we try to control the risk, control the risk. Let's say if you are going and the trade is actually wrong. So in this case, 1% is the common wisdom. So which means if you have 100,000 in your account, you cannot lose more than 1,000 in every single trade. So because if you take out one marble, if you will still have 99 marbles, so you can continue to trade, right? So the advantages and disadvantages here is where we talk about is in spread trading is you trade with spread trading, so you will have all the advantages and disadvantages. Okay, so let's focus on this. Okay, first, trading the spread, you will have a reduced risk, all right, and you enjoy lower margin. Okay, we'll show the margin, and you have higher return per dollar risk. Okay, this is quite critical as well. And yeah, there are other benefits which we could explain from now on. Okay, you increase your leverage. This is also true. But as I said, increasing leverage, increasing your risk. So that's why you have to be very, very careful in terms of controlling the risk. Okay. Now you have to spread to other months. So this is what BMD has, and it's easier to place orders. I'll show you the orders how it's placed, and you have a lot of movement as well. Okay, and BMD futures suitable for candle spread because we just explained, because we have 30 contracts, for example, more than 30 contracts if combined. So let's look at this is the example. You have so many contracts trading, so that's why the combinations of all these contracts, it creates more than 30 active contracts. That means we are probably trading more than 30 contracts at one time by many traders. These are the active spread candle spreads. So what you have is, let's say if you have July August, then you have July September, you have July November. So all these combinations give you a good trading environment. In fact, most of the months are actually trading actively. So that is why the advantages of we are trading this spread. Now, one of the advantage of trading spread is because if you're trading outright, means you buy CPU and sell CPU as an directional trading. Sometimes the price moves so fast, it could be like as far as it dropped 50 points in just half an hour. Recently it went up 50 points just in half an hour, and over the 2-3 days it went up like 200-300 points. So is this fast? Of course, if you're getting the direction correct, this is good money to make. But what if you're getting it wrong? And the chance of getting wrong is actually still high, even though you're trading full time or trading thousands of times every day. So that's why you have to control this. So how to control is spread, actually, because you buy at the same time you sell at the same time you buy. So directly you apply bricks into the prices, so the prices will move slightly slower. So once the price moves slower, then you have chance to make decision, to do the necessary damage control if anything wrong comes in in your trade. So this is how and why we trade spread as well. Okay, now another advantages we probably favor spread is directional, and trend trading is actually to me is quite hard to predict. It can be one day go up, the next day go up again. So you think the next day going up again, so the next day can be everything collapse. So since it's difficult to predict whether the directional of the market, the prices are going up and down, so why not we don't predict it? We may actually do something else. We predict that, for example, just now I show you the near months price are lower than the further months, so which means the price will go up eventually. So at least I know that I could do a long spread. In long run, I still can prosper for it. For example, nowadays the spread is different. The near months is very high. The demand is good actually. The far months is actually lower. So what means it means that the demand is there. It's going to be stay. So you got to do some trading, which you see that the outright prices go up, but not necessarily go up all the way. Okay, so this is how you can do a different trade from a directional trade. Okay, another thing is position trading. Position trading, I think it's easy when you buy one lot and then keep for probably days or months. When it's go up, you can make 100 points profit pocket. Okay, but in reality, it go up and down towards the whole day, the week. To hold on to 100 ticks is so difficult. It's so difficult. So you have to be very very good uh, in it. Then only you can hold on to, let's say, to pocket a 50 or 100 points. But if you look at the price ladder, one lot, two lots shouldn't be a problem because you can easily get a size fill. But what if you are holding 10, 20, 30, 100 slots? So it's difficult for you to hold a position which you don't see a sizable size for you to get filled once something is wrong. So that's why trading a position trading require actually much more discipline, much more techniques to be applied. Now, third, I don't know which one of you. So, margin is one of the reason why spread trading is so attractive. Is because trading an outright position, you need 5,000 margin. That's reduced to 4,005, for example. But trading a spread now is actually also increased to highest is at 1,200,000. You see, you buy a January contract, you need 5,000. You buy a January, then you sell February, you will only pay 1,200 for the margin for both contracts. So this is the advantage of trading spread. You have a lower margin. I'll explain to you why the low margin is one of the benefit. Next is we can see that gap. You see, gaps has gone very common in CPO because, as I say, CPO has been traded related to soybean and crude oil, which is they're trading around the clock or during our nighttime. So during our nighttime, there are so many gap up and down. The price actually continue to move, but because we are not moving, so the next day we try to catch up during the open, so our market price will gap up. It's not easy to predict whether the market going to gap up or down tomorrow morning. So what you do is intraday trading the close position before the end of the day. But if you're holding a position, then it's tough because the gap up, you may make more or you could actually lose much more as well. So in order to avoid this, let's take a look at spread trading. The same day, the market may give up 50 points, okay, in this context. But if you take a look at the same contract but in spread price, it's almost has got no gap at all for the same contract. But adjacent are two contracts. So spread has got almost no gaps. So that makes gap. Trading spread is actually become something that I look for because you don't want to wake up in the morning immediately you lose 50 points, right? Okay, so that is the objective, and spread works in sideways markets. Okay, so this is the benefit that you actually can get from spread trading. Now, what are the strategies? Another benefit is actually, you see, spread is not only spread. Spread, you can create some strategy. As I said, you trade one long spread, then you roll the contracts. You can also combine two spread to become butterfly, to become an iron condor. So these are just one sell spread, one buy spread, and then one buy spread separate the months, and you buy spread again. So this combined become different strategies in trading so-called spread. Okay, now strategy. Why is trade in a strategy? Because you have better chance to survive in turbulent market. Okay, market can be very violent suddenly. Okay, spread also very violent these 2 days. Okay, so but the outright prices are even more violent. So in a way, it's actually allow you to survive in the turbulent market, and you're trading both directions so that you're not so controlled by only one direction. And to manage a losing position is what strategy can be work for. Let's say sometimes you lose money, but you can try to think of a strategy to avoid cut loss. Okay, so that you can actually manage a losing position, extendable to other products. Because if you know how to trade spreads, then you know that you buy one contract, you sell another opposite contract in somewhere else, then you create a spread. Even there are people trading spread in stocks. That means they can buy A stock and sell B stock. Of course, you need to short selling a stock, then it creates a strategy called spread. And the good thing is it's adopted by professionals. Right. Now, just now we mentioned about butterfly trading strategy. Last time to trade butterfly strategy, you need to buy a contract and sell contract and then buy another contract. But Busa has created a strategy called butterfly quotes in a ladder. You can buy the butterfly quotes ever since 2017. You can buy the price as in outright, you just buy the price from a ladder. So this actually also makes the advantages of spread to become versatile in trading this strategy. Now, basically, to take advantage of this, okay, because your loss in one side, you gain by the other side. Okay, therefore the spread trading has a low risk than outright. Now, all I have been saying is you have lesser risk. Okay, then what you can do once you have lesser risk, you need to think of strategy how to plan. As I said, there's a bull spread, there's a bear spread, and then another advantage is we have been talking about lower margin. A lower margin means that retailers are also suitable to trade. This is what also important because so everybody can start feeling about the so-called spread strategy. Now, spread has got another advantage is that the range is big because sometimes the spread can go like 10, 20, 30. There was extreme times it can go, the spread become hundreds. That means month number one and month number two, the difference of prices can be as big as 100. Now, example is here you can see that there is a time where the spread went to 40, the difference of 40 and down to 10, just in few days or in a month. So if you holding a short spread in this case, you see you don't have to buy. In this case, is June and then sell July. In Bursa Malaysia quotes, you can buy the June July quote or sell the June July calendar spread by using the ladder. That means you just in this case you sell at 40, you sell the price at 40. Then when the price comes down, okay, let's say for example, let me highlight this. Okay, when you think that the price is actually picking here, let's say for example, you apply a head and shoulder or any strategy that you can think of. In fact, the technical analysis point applies to spread as well lah. Okay, you think this is high, so what you can do is you short at 40. So that time the CPO can be priced at 2,300 or 2,340. Then the next one is 2,300. Okay, so the spread is 40. So you don't have to think about the outright prices of 2,340. All you need to do is you sell 40 of price spread. And if the price went down to say 10 and you buy back the 10, you sell June, July 40, you buy June, July 10. So how much you make? You make 30 ticks, 40 minus 10. So you just consider this is a stock called June, July stock. Okay, you sell at $40 or 40 ringgit, you buy back 10 ringgit. So you get a difference of 30 ringgit in your pocket. So this is your profit, right? This is how spread actually, yeah, that's how spread actually works. Okay. In fact, uh, the indicator here used is stochastic lah, 14 and 3 stochastic, slow stochastic. So yeah, you can apply the technical indicator into trading spread as well. Okay, another example of spread. Okay, you can use indicator. Okay, as just a normal technical analysis indicator. For example, the price here is 42. It went to 4. Okay, you can use a common crossover signal. Crossover signal is applicable, but of course, in order to get of course, it's not not common. Let's say if you look at spread, because spread only move a few ticks, in months, so you have to adapt a bit. Get a chart, okay, read the chart a bit. This is one of it. Besides the fundamental I've just spoke to you about in the earlier. Okay, the fundamental is what makes the price curve up, back rotation or contango. But the technical is another aspect some of the traders looking at, especially those intraday traders. In fact, intraday traders are looking at uh, time and sale. So which means you can get a time and sale. Let's say how many lots are buying at this price, at what rate, how many lots are done in this price and what rate. So that's how people trade as well, especially intraday. Intraday spread trader means they buy and sell the contracts. They don't keep overnight position as much as possible. So these are people trading this way as well. All right, so move to another topic. Now, you have good point, or you also have bad points. All right. So the disadvantages of trading spread is limiting your risk. Okay. At the same time, limiting your reward. So the returns will be lower. So you're trading outright, maybe talk about, you make 50 or 100 ticks, but trading spread, you talk about making 2 ticks, 3 ticks, 2-3 points only. So this is how we differentiate from other trading. You have higher brokerage as well because you're trading both sides. You're not doing long. Every time you go in, you long one side, you short one side. So your brokerage is double. But I believe the more you trade, the brokerage will be low because you're generating broker more volume. You'll be able to negotiate with broker to get a lower commission. Thirdly is lacks of information because yeah, as I said, initially it was a best kept secret. When I was trying to discover spread trading, it was hard for me to find information. In fact, there's no information. The only information in spread is you find something in options. But yeah, as you discover more and more information, then I became a local participant of BMD. With this, I have been explored to many opportunity to learn from other traders. I been go to overseas to meet other traders. We share strategy. This is how we pick up, but of course you need to pick up what is basic as a spread. So I'm trading for a while, then become local participant. This is my path, as I explained, in last month how I become a full-time trader. And also the orders are confusing if you have, just like my background. I came from trading stocks and then towards futures and then towards spread trading. At first, I actually recorded all the prices. Let's say I buy CPU at 2,400, then sell 2,400 something. This spread actually make money or how? So that's how I actually use 1 year of my time to make sure that spread is actually very real work. Unfortunately, at that time there's no seminar, webinar, talk about spread trading in palm oil. So I have to do it this way manually. After sometimes I discover that you don't have to worry about buying the spread. What are the outright prices? So buying a spread means you buy the spread at 2 ringgit, you sell at 4 ringgit means you make 2 points. If you buy you sell a spread 10 ringgit, then you buy back at 2 ringgit, okay, that means you're making 2 points also, 2 ticks also. So this is how you read spread. You don't have to worry about the outright prices anymore. So now when I teach other people, I said just buy the spread and sell the spread, or sell the spread then buy spread. So the difference is a profit. Do not need to care about the outright prices, whether it's 2,400, 2,400, 300, okay? Because this is automatically done by the brokers and the exchange. You will get a correct contracts on your hand. Your profit P&L will be correct, okay? Then lack of stop loss strategy, because yeah, you can't buy two and then sell at zero. You cut loss, you lose 2 points. A lot of cut loss will be, you know, losing money in your account. So normally we do hedging. Hedging is simple. So you just buy January, February, then you sell February, March, then become hedging pair lah. So when position build up, unfortunately too big, okay, the risk is still increased, and yeah, the risk can be still real if your position is actually big. Now, spread sometimes confusing because let's say for example, CPU has been going up for the past 1 week all the way to extreme 3,000 over. But what happens to the spread? All the spread comes down. Okay, the spread go in opposite direction. Yes, there are times that because the far months pick up faster than the near months, so the spread actually could go down. So this is actually can happens in spread. Although the market is actually bull run, but your bull spread actually could lose money, right? So sometimes this is example is you see the spread come down, but the outright prices go up. But this is older example, but this is true. Okay, so the bull spread and bear spread, it could be reversed at time, so you have to be careful on this. And also too many contracts also confuses you, so you don't know whether which contract you want to buy and which contract you want to sell. All right, so the simplest answer is trade the most active one is the safest bet, but not the, don't limit yourself. Eventually you can trade more contracts and so on. And because spread trading is hedging, and spread position can be hedged again and again. So there are some aspect you need to understand to start trading spreads. Of course, you can ask me in a bit so that I can explain to you how this thing can be done. So basic things like which contract to trade and which to avoid. Of course, avoid the month, the second month and spot month, and the trading tools and strategy. So the strategy basically you just trade either fundamental or you trade technical aspects and hedge when the position goes against you. Now, a quick one before we go to a Q&A session is I gather this from some audience years back. Why there are some traders that are not trading spread. First thing, because they might think it's difficult to do spread trading, which is not. Spread trading is like driving cars. Once you know how to drive a car, it's actually as easy as you do any other thing lah. So second is, why allow one leg to lose if you actually know the direction? The fact is, we don't know the market go up and down at any given time. We think the market go up, the market can go down. So I try to avoid guessing the direction. That's why I trade spread in this case. Thirdly, is brokerage is high. It's only favor the broker. This is not true. The brokerage can be low if you actually trading spread. In fact, more and more broker are spread friendly. That means you ask them about spread trading, they know what you're talking about. They will actually provide you a scheme or package. If you can trade spread, they'll be more than happy to provide you a package. So do ask your broker. I'm sure they will answer you. Okay. Fourth is it moves too slow. Oh yes, spread supposed to be moved slower because this is the strategy we try to do, right? Remember? Okay, and then it is more excited to trade outright. Yes. Okay, it's so good when you tell people I make 100 points today, rather than you ask me how many points I make. I said 2. So yeah, so the excitement is there, but I would rather trading become as boring as possible. But one excitement, I watch a movie at night. So it's a choice. It's a choice. But to me, I rather my trading be as boring as possible. In fact, most of the time my trading is boring. When my trading is not boring, means I'm not doing well in my trading anymore. So I need to do a lot of hedging lah, cut loss lah, do a lot of things. So yeah. last but not least, I think most of the books and stories was about outright trading. Not many people are talking about we trade spreads, we make 2 ticks, that kind of thing, or we make 4 points in a single trade. So this makes spread trading become something less aware. But I can assure you, if you trade spreads, it will bring you to a whole new world of trading. In fact, in my knowledge, there are more people, in my knowledge, there are more people, especially in the professional line, are trading spreads than outright. I'm not sure how other people perceive, but this is my opinion. So with this, probably I will pass the presentation back to Shane, and we can go to our Q&A session. Do ask me anything, so I try to answer at my best.
Yes, thank you so much, CC, for your wonderful session on spread trading, the best kept secret in futures. Okay, so if any questions to ask our speaker, CC, please write in the question and answer box. We will do our best to answer as many as we can. Okay, so the first question from Samuel is, how do I see spread charts for FCPO and FKLI in trading view?
Unfortunately, TradingView does not provide the spread trading codes which you can so-called track because there are so many spread contracts, and many platforms are designed for outright trading. But the good thing is, what you can do in TradingView, for example, is that you can call up the formula. So you call the first CC contract, I think C1. Should I call C1 or one exclamation or one contract CC1 for CPO minus FCPO C2 or the second continuous contract. Then you get your spread contract artificially lah. It's not perfect inch perfect as a actual spread contracts, but they are actually as good to use as possible. So that means you can use a trading wheel, call up the first instrument, which is your FCPO C1 contract, which is I think one exclamation, minus the 2 exclamation, the CC number 2, the second continuous chart, okay, of CPO. Then you get the difference of these 2 prices, which is the spread chart. I did compare to our actual spread traded prices. They are in the same range, but not exactly pinpoint at the place. But this is the best chart you can get if you get from TradingView.
Okay, thank you so much for answering this question from Samuel. So there are actually a few questions, a few participants that ask the same question. Where and how can we learn more on spread trading? Or do you provide any course?
I used to provide some courses and conducting some briefing to professional traders and so on. But recently has got less programs on it. But I'm sure in the market, yeah, this is very difficult to find because so far I wouldn't find a book on spread trading, especially related to our market, the calendar spread. So it's difficult actually. But I'm sure a
Okay,
lot of
okay.
people have been trading spread nowadays.
Yeah, more and more people are doing that. So if
Mm.
you're interested, you can contact our speaker yourself. Used to teach, but
Mm.
now retire already. Okay, I mean, because too busy making money from futures trading,
Nah.
no time to teach you how to trade spread trading. Okay, too
No, no.
busy doing that. Yeah, I remember when I met you, a couple of years ago, you were still conducting classes, but now
Yeah.
I think no time already. Okay, yeah. So if you want to learn more, join our futures webinar. If not, you can
Mm.
contact our speaker separately. Oh yeah, there are participants who ask you, you should write a book about that. Okay, since nobody wrote about that. Yeah.
I think I'm not qualified yet to write a book to become author.
Mm. So just now you mentioned that there are intra-market, inter-market, and inter-exchange spread, right? So do
Mm.
you also have so do people trade intermarket like FCPO and FKLI, or only FKLI and FM70?
Uh, Actually, you can see there's a lot of trades on CPO or FCPO contracts. They are actually a spread contracts from Dalian, for example. You know,
Mm.
people buy Dalian China palm oil, they sell Malaysia palm oil, or they be buying palm oil, sorry, soybean oil in US seaboard,
Yes.
but they hedge they're selling Malaysia palm oil. So there are a lot of contracts. You see, it's very funny. The market keep going up, but a lot of people selling. Why? These people actually maybe they make money from another instrument. Can be Thailand palm oil, can be soybean oil, can be crude oil, but they're selling Malaysian futures FCPU. Why? Because they want to become market neutral. So in case they are wrong in one side, they have another leg which is correct. So this is how spread trader try to make themselves always not to be exposed to one direction. You see, the direction can be wrong so fast and so damaging. So you try to be as market neutral as possible.
Okay. All right. So the next question is how does FCPO correlates with soybean oil and crude oil? Is it a negative correlation or positive correlation? And why does it happen? So this is from our friend Yong Shen.
Basically, they are positive related because soybean oil is our competitors. That means both oil, let's say, consumed by a big country, say for example China or India. So they buy soybean oil, but some of the product they need palm oil. You see, palm oil can be used to produce soap, uh, washing detergent, or your shampoo. So these are used, produced by palm oil. So they will buy this, but once they cannot have this, or the price of, let's say, palm oil are so expensive, they will buy another oil, or sometimes the soybean oil is actually more expensive. Usually it's more expensive than palm oil. So if they cannot find enough soybean oil because the harvest is not good in US or Canada or Argentina, so what they do is they will buy substitute oil of palm oil. Let's say palm oil has been so much stock, so the price are so low. Soybean oil has been so pricey because demand is high or the harvest is not good. So instead of people buying more soybean oil because it's so expensive, they will buy the palm oil, which are relatively cheaper. So if soybean oil continue to shoot up because of bad production, low production, so nothing happened in palm oil, but palm oil price will shoot up because everybody knows that if soybean oil are too expensive, eventually palm oil will be expensive as well. So I buy the palm oil before it become expensive. This is what happened recently last 2 days because uh, soybean oil has been so strong. So uh, they are push or buying power for the palm oil as well. So these are positive correlated. Now, crude oil, what happens to crude oil? Crude oil is also related to palm oil because palm oil, the cost per ton is actually more affordable than soybean oil. So a lot of countries using palm oil to produce biodiesel. Okay, especially let's say for example US, US they're using soybean oil. uh,
Indonesia,
Malaysia, Indonesia are going to implement B40. That
B30,
means
B30.
they excuse they will use quite a lot of biodiesel in their commercial diesel market. So that means the crude oil, if crude oil is expensive, that means the margin, more people will be using, especially Indonesia, because Indonesia is net importer of crude oil. So in order to produce biodiesel, they will consume or convert all the palm oil into biodiesel, so that uh, the net stocks left for edible oil is lesser. So if crude oil is expensive, palm oil will going to be expensive because country like Indonesia will be using all their palm oil to convert to biodiesel for their local uses, so that they don't have to pay so much imports for fossil fuel. So this is how these things are related, right?
So both soybean and crude oil also has a positive correlations with the SCPO
Right.
here. Now, is it which one is a leading indicator? Like which one leads the other? Like
Mm. Actually, it's quite complex. Everybody is actually crossing each other. Sometimes palm oil, you see, it must be a team play. That means something big happens in crude oil, then crude oil will drag everybody up or down. Something very big happens in Malaysia. Let's say, for example, suddenly we announce we are in shortage of manpower to do the production. We are, or opposite, we have actually run out of storage, which like last year run out of storage to store our overproduced palm oil. That's why, therefore the price went down to 2000. But everybody knows that down the road 6 months, it's not going to be overproduced, because eventually the dry seasons comes in. All this will actually hamper the production. The production will come down, and eventually the stock come down. So which is the leading indicator? As I will say, it's difficult to say, but for palm oil and soybean oil, most likely the leading indicator will be depends on time zone. During Malaysian time, the team player usually will be palm oil. At night time, uh, this soybean will be affecting the price index, and vice versa.
mm. So the next question is from Ken, which is if today I buy December month and sell March, after 3 weeks, can I just close the December alone and keep the March open?
Okay, in this case, you converting your spread become an outright position. So unless you are well versed that knowing that the outright position of March is going to be making money, otherwise you are actually facing the speed or the P&L of your March contract alone. So you're no longer trading a spread. Just to remind that you buy December and sell March, you can buy a December March contract. So you don't have to go to the outright and capture the price. You can capture the price from a spread alone. But if you unwind one leg December, then you have a net. You buy December, you sell March, then your March become naked short outright position. So you have to bear in mind it can be done this way, yes. But your margin will be increased from 1,002 to the outright margin. It can be 4,005 or 5,000, depends on the time now when what is the margin for the time.
Okay, so it can be done, just that
Yes.
there are things that concerns that you need to be aware of.
Mm.
So next question is what is the relationship between our palm oil and China Dalian RBD Olen? Okay, both move in
Okay.
parallel.
All right. Most likely they are moving in parallel. The reason is um, our crude palm oil is the oil that you press and cook from the fruit, so it looks very uh, dirty actually. It's sort of like smelly as well. Okay, so these are the oil that we are trading, but this is actually not only the oil that we're exporting. We are exporting another oil after this raw oil, crude oil. You refine it. The refined process called RBD. It called refine, bleach, and deodorize. So that means you remove the smell, you remove the coloring, the dirtiness, and you refine the oil become, let's say, uh, 18 degrees or 24 degrees. So then we export this oil. This oil can be edible oil already. So the Dalian is an exchange traded in a Dalian commodity exchange, which they import this oil and they make it a commodity contracts. And this oil is the RBT oil. So are they related? Yes, they are directly related, because the oil is actually from the crude, the raw material itself converted to a refined oil. The difference of the price, they are slightly higher. The reason because they are refined oil. So their cost of producing is slightly higher from CPO. So they are actually almost 100% related. But in order to hedge, they will have some formulas to hedge. Almost you can hedge it directly actually, but the contract size and contract spec is slightly different. So therefore, and then they are in different currency, but whether they are correlated, yes, they are directly very much related. That means if you see Dalian up 3% at night, most likely you'll see a gap up, next morning in CPO.
Okay. So Thailand's 3 hours is much later than us.
Uh, Thailand trading hours, they impose the different trading hours. They have a night trading hour, which from 9:30 to 11. They have a night session, okay, which is they call a start session, and then after 11 they stop, okay. Then they open at 9, which we open at 10:30. So they cover the different zone. After 10:30, then they will look at our market. 10:30 open, they will actually track our market. We'll jump up, jump down, and then we close for midday session. They start at 1:30. They start earlier than us. They close at 3 p.m. We used to start trading 3 p.m. continue from that time, but this time, I mean, Bursa has got make an amendment. Our trading session start 2:30. We start 30 minutes earlier than Dalian close, so which make things more exciting, because when something wrongs in trading in Dalian in China, what they need to do is to hedge our market, CPO market. So that's why if something happens during that last 30 minutes of their session, our market become very active. So this is how genius, these things are. People in China, they have trading problem. So what they look at is where else I can hedge. So immediately now they know Malaysian market open at 2:30 to 3 p.m., which before they close. So before they close, they will hedge in our market, and then our market continue resume. Okay, we continue to, let's say, 4 p.m. Some other market open, let's say India market, European market also open. They find that the position in soybean or other oil, edible oil, or other crude oil, they have trouble. So they also start hedging in a CPO market. This is what really happened. That's why you see, as the market opens and closes around the world, during our session, they will be affected if something happens. So there are how highly related of all these commodity. That's why I said the good contracts of trading CPO is you're trading with the whole world. Okay, it's not easily control. In fact, I would say impossible to control. It's something that if you really make money out of it, so you really need to have the skill trading it. So once you have the skill, you can benefit of trading, because you're trading with the whole world. Everything is affecting the prices, but the good thing is, maybe the currency is affecting it, but let's say probably the geopolitical uh, may not affecting the market so much, or a small local rise issues will not affect uh, the prices of CPO. Okay, so you are trading one relatively, you can say it's volatile, you can say it's actually less localized product in Malaysia's soil itself, and we are trading in ringgit. So which means if your major assets is in ringgit, you don't have to convert this to USD, and you're facing the risk of currency losses. Okay, so you're trading ringgit and you're trading the world. So this ringgit dominated CPO actually allow allow something that we can do in locally, but reach out to a global exposure. That means our market shares, or you can say that because we have to generate money from somewhere. So as a trading, so if we reach out to the world, that means we are actually connecting to the world. We can actually capture some profit. Let's say, for example, somebody hedging CPO from a crude oil, so they make money in crude oil, they lose money in palm oil. This is what we try to capture. You get what I mean? So with this kind of market, you can have exchanges contracts so frequently, because a lot of people are hedging here and there. Hedging is like buying insurance. So once you buy insurance, the agent may make money, right? So we try to become the broker or the agent. So we provide some liquidity to other traders. So other traders are willingly to pay us some profits, so that we can actually allow them to hedge. And then what I do, I try to hedge my position as well. So how I hedge another month. So that's, indirectly I'm trading spread. They are hedging our contracts, and we are hedging ourselves, in different months. This is how beautiful calendar spread trading is in Malaysia.
Okay, well said. For our FCPO, which is the world most renowned crude palm
Yeah.
oils contract, and it exists in Malaysia. So as Malaysians, we must take full advantage of
Yes.
this world popular trading instrument here.
Mm.
Now, besides Malaysian, which is famous for the crude palm oil, uh, which other exchange also offers a crude palm oil? We know we got Dalian. Okay, does any other exchange aside from Dalian
There
also
are some
provide?
exchanges providing these contracts, but they are different. Also, RBD in nearest our neighboring country, Apex Exchange also providing it. But of course,
That's
they are trading
Indonesia.
in US. Indonesia, I think they have something comes out like this, but I don't think it's actively trading or it's not really working out. But in terms of versatility and in terms of actively trading, as you know, Malaysia, especially denominated ringgit Malaysia, there's only one contract that you can do, because any other contract, let's say for example, you want to trade Dalian, it's not easily you can trade Dalian because you need to open up a company, because futures contract are not open to non Chinese citizen. So it's crucially difficult for you to trade. But of course, Malaysia is open country, which any other countries can trade into our market. So the benchmark contract of palm oil is actually in Malaysia. Even though when I went to China in the seminars, in their conferences, China is actually trading based on our information. Of course, we look at their Dalian prices, but to them, more important is our MPOB data, which you get the data every 10 in each calendar month. Those data is the most important crucial data which compiled by Malaysia. And why people trade Malaysia, and take a look, CPU has got as of this benchmark contract prices discovery, because our data is very transparent. You can get 10 years data, 20 years data from our MPOB data repository. They have all those data, they publish on time. That means last month data will be published on the 10th of the next month, which is timely and quickly. In fact, before the data is published, it's already a lot of surveys company, bankers has also done the surveys. Roughly, you know the figures, what it's going to look like. So it's not easy to get this kind of transparent and timely informed. And this information is available. I won't say free, but yeah, our government has got all this mechanism to publish all this data. And if you have a broker, your broker will be more than happy to help you to probably forward you the messages on all these researches. Yeah, so that's why uh, if we talk about crude palm oil in this section, or edible oil, this is the country that Malaysia, that you have the ringgit denominated and the most, I would say, benchmark of crude palm oil or palm oil in general in the world.
Mm. It also makes our currency in demand, because if they want to hedge our Malaysian palm oil, they have to buy our ringgit.
Mm,
All right.
in a
So
way, yeah.
yeah, in a follow-up question of all this inter-exchange spread, uh, this question from Tong is that which exchange is leading which exchange between Dalian and BMT?
As I said, depends on time zone. Let's say at night, of course, Thailand will be the one that interpreting and discovering the price. During our time, definitely, Malaysian trading hours, they are actually looking at here rather than that side.
Okay, now the next question is, if my broker does not provide spread trading, can I just do outright by buying T month and selling T plus 1 month?
Don't do it, because the speed and liquidity that you can find in the outright is actually much lesser than spread. Let's just spread. You want to buy 10 lots. You maybe look at you buy 10 lots. You just buy at this price. You get the spread. But in outright, to do a 10 lots transaction, you may move the price by 2-3 ticks. That means a slippage will be 2-3 ticks. You will be making less 2-3 ticks, which I would say don't do it. I'm sure your broker will have it. You have the prices, but certain
Yeah.
time the platform may not enable with it. So you may request a different platform, or you request to enable the spread in your platform.
Okay, excellent. Now, there's a question from Raymond that asks, which security firm is active in providing spread trading?
Actually, most are actually have spread trading by default. But if you talk about which one is most active, I think you can just go to BMD website under derivatives. There's a broker rating. Okay, sorry, broker ranking. So you will see the broker ranking in terms of let's say CPU. If you see the CPU is very high in terms of CPU, CPO CPO contracts, most likely they are very active in spread trading, because spread trading generating a lot of volumes for our CPO contract as well.
Okay. The next question is which website can we go to get a 大连 live data?
Dalian, in fact, usually what we use is a software called Wenhua, WENHUA, WENHUA. Look for this software or app in your phone. Usually you can get the palm oil Dalian prices at your hand or in your computer. Or Dalian website also provide, but usually website will be delaying by 15 minutes.
So the Wenhua is real price feed, real time price feed.
They also have delays in certain forms, so you have to be checking on which contract you're looking at.
So just like you were saying that 大连 one is crude palm oil or is RBD?
They are trading RBD only actually.
So the only RBD lah. So crude palm oil
Yes.
only Malaysia has lah.
Yes.
Yeah.
The good thing
Okay.
is the Wenhua software has got Malaysia prices.
Oh, okay.
It has
Okay.
Malaysian prices.
All
Yes.
months, all months or only the
Yes.
spot month?
Only 12 months. Only 12 months actually.
12 months. Okay, excellent. And just now you were also saying that the soybean oil is usually trading at premium to our crude palm oil, right?
Yes, usually premium. There was certain times the last year and recently we almost trading at zero premium. So usually when zero premium or even reverse premium, that means palm oil is more expensive than soybean oil. Normally for spread trader, you will buy soybean oil, you sell palm oil, because the norm is soybean oil are priced higher than palm oil. Because palm oil is
Okay.
like such a crop that's so effective. You plant the trees, it can actually provide you fruits for the next 10-15 years. While soybean you have to replant every season. So that's why our price is usually much more affordable than soybean oil.
Okay. So the next question is, how do you roll your contract using a derivative account?
Okay. If you're trading, let's say December now, you're doing a long contract December. So how you roll your contract is you sell a December January spread. December January spread. You sell December, you buy January, so that your net long December, because you sell DGen, so you cancel off the December January, you get a net January long. So your long January contract become long. Your long December contract become a long January contract. So that's how you use spread to roll your contract. Just you long, you sell spread. If you short, then you long or spread, then you actually roll your contracts.
Okay, thank you so much, CC, for your sharing and doing
Yeah.
this question and answer with our audience, a few hundred of them. So right now, let me take over the control as the presenter to share with you, what is the next session for you. Okay, so for our next webinar, we have inviting a speaker to talk about momentum trading strategies for catching early trends. Okay, you see, like the name suggests, this is like a momentum trading strategies, and so of course we will focus on outright trading. So the topic will be conducted by Mr. David Low, who is a veteran speaker in the industry, and the date is on the 1st October, which is a Thursday. Next Thursday, 8:30 to 10 o'clock. So let me just put the next webinar link in the chat group. So Don't miss out our next webinar by a veteran speaker and also traders by joining our next webinar. The registration link is already put inside the chat group. So an exciting news to announce to you is that we are doing a post-webinar survey. So for the 6 lucky respondents who answer our survey will walk away with a touch and go e-wallet reload pin worth 50 ringgit. So every session we will pick 6 lucky respondents who answer our survey, and then to give you a touch and go e-wallet reload pin worth 50 ringgit. So what you need to do just to answer our survey, which will be launched after this webinar and will also be sent to you via email. So lucky winners will reach out to you within a week, usually in just a couple of days. Okay, so that's all. So please, we want to hear from you whether our speaker, how have you learned from our webinar, and then what else we can improve. So let us know about this in our survey, and we'll pick 6 lucky respondents. So that's all for this session today. So thank you so much everybody for tuning in our session today, which is spread trading, the best kept secret in futures. Thank you so much, CC, for sharing your
Thank you.
the insights with us on how we can do spread trading in the BMD market. And so I will see you all in our next Thursday futures webinar. All right, bye everybody, and have a pleasant rest of the day. This is Shen Chu signing off.